If you think you're going to participate in an IPO and you have equity, here's what you absolutely need to know. Non-qualified stock options are a lot easier than incentive stock options because they don't have any additional tax benefits. When you exercise your non-qualified stock options, everything gets immediately triggered as ordinary income. After that, it's as if you just bought the shares outright, and so you get to participate in long-term or short-term capital gains or losses, depending which direction the stock price goes. With that in mind, many people decide to sell their non-qualified stock options as soon as they vest because once again, there's no additional tax benefits and they want to capture that liquidity and then reinvest it in a direction they see fit. I highly advise you against exercising non-qualified stock options at a pre-IPO company because there's no market for selling those shares, so you can be saddled with a tax bill and have absolutely no way of paying it. Some people do consider exercising non-qualified stock options as an early exercise when the spread is negligible because there's not a lot of ordinary income, and then they get to participate in a lot of the upside potential and long-term capital gains. And then sometimes people would decide to exercise non-qualified stock options because they may be able to participate in the qualified small business stock exemption, which basically allows you to avoid all capital gains if the gross asset value of your startup is below $75 million now. That's something you better talk to your CPA and CFO about. But here's one really important key insight when it comes to non-qualified stock options. Non-qualified stock options give you one specific benefit, which is you get to participate in the upside without risking any of your own capital. And there's a ratio that us financial advisors use. It's called the inside ratio or information ratio. And it basically compares how in the money are those stock options versus how much more time you have left on those stock options before they expire. And so if you're holding non-qualified stock options and there's a lot of time still left and they haven't really appreciated a whole lot, usually that means it's a good idea to keep holding them. Alternatively, if they've appreciated a very significant amount, you're running out of time before they expire, which is usually about a 10-year window since the grant, we usually say exercise those because most of the value has already been recognized. If you're navigating RSUs, ISOs, non-qualified stock options, or any other form of equity compensation around IPOs, follow us along for more and reach out to us if you need help.